Hey guys, what's up? I'm Erin and welcome back to the channel. What if you gave AI $1 million and said, don't just grow the money, but use it to guarantee peace of mind? Maybe you might expect certain stock picks or tax loopholes. Instead, here's what I actually got. If I were handed $1 million and asked to deliver peace of mind, not just performance, my goal wouldn't be to chase the highest return. It would be to build a low-stress financial life that can handle volatility, health changes, family needs, and whatever life throws at you. So, according to AI, here's exactly what I would do with $1 million and why. Step 1, secure the downside. $300,000. Before you build wealth, you need to protect your foundation, and that starts with reserves that help you sleep, not sweat. Emergency fund? $200,000. Park this money in a high-yield savings account or CDs, getting a 4.5% to 5% interest rate. That's going to give you anywhere from $9,000 to $10,000 per year. This fund would cover 6 to 12 months worth of expenses. It could cover you if you had a job loss, a home repair, a car repair, or a medical emergency. If your monthly expenses were $7,000, you'd have nearly 2 years worth of expenses in this fund. Then $100,000 to short-term bonds. Ideally, this would be allocated into US Treasuries or short-term bonds, getting you that interest rate of around 5%. This money could be set aside in a place where it's guaranteed to be there when you need it. Maybe you use it for upcoming expenses, maybe you buy a new car, maybe it helps with education costs down the road. This fund would help prevent you from having to sell your investments if there was a market downturn. And again, this goes a long way for peace of mind. Step 2 is to secure your shelter. $250,000. Peace of mind starts at home, literally. If you have a mortgage, you can aggressively pay that down, especially if it's sitting at today's rates of about 6.5%. That is a guaranteed savings of 6.5%. This is a very wise use of your funds. If you're renting and planning on moving to a home one day, well, you can invest this conservatively in a place like CDs or someplace where it's guaranteed to be there. You get some kind of return on your money, and then when you're ready to take the plunge into home ownership, that money is there for you. Because once your housing costs are taken care of, everything else has a way of feeling a little bit easier in life. And sure, $250,000 may not cover your entire housing costs, but it can certainly make a dent in an outstanding mortgage or be a great down payment. Step 3, build long-term wealth. $300,000. This is where you let your money grow without losing sleep. And AI recommended investing it in low-cost diversified index funds, giving a sample portfolio of this: 50% to US stocks, 20% to international stocks, and 30% to bonds. This is to be held across tax-efficient accounts like tax-deferred accounts, 401ks, IRAs, as well as taxable brokerages. This gives you broad exposure, keeps your fees low, and really focuses on long-term growth. Historically, this mix could return maybe 6 to 7% annually. That's $18,000 to $21,000 per year without chasing headlines. Step 4 is to create reliable income, $100,000. Here the goal was to create cash flow by investing in dividend-paying stocks with the focus of growing this income over time. And as an added bonus, AI recommended putting these dividend-paying stocks like Microsoft, Johnson & Johnson, Coca-Cola within a Roth IRA, so you're not paying taxes on those dividends when they are received, and once you get to retirement, you get this income tax-free. At a 3.5% average yield, this could generate about $3,500 a year, and this income would ideally rise with time. Here the goal really isn't yield chasing, it's predictability and peace of mind. And finally, step 5, a fund that calms your soul. $50,000. That final slice is all for peace of mind money. Here's what it might go towards: years of travel, perhaps a 3-month sabbatical from work, paying off your parents' debt, a trust for your child or grandchildren, or just launching a dream side hustle. This fund is a great reminder that money should serve your life, not the other way around. So here's what I absolutely loved about the recommendations. 1, paying down the mortgage. This buys you freedom, reduces stress, and frees up cash flow. And if you have a mortgage at today's rates, you're getting a guaranteed return that beats most bonds and high-yield savings. Next, they actually got invested. There was no sitting on the sidelines. The plan leaned in to getting invested and taking advantage of index funds, because what matters most at the end of the day is that you get started. You cannot time the market, just try to be in the market for as long as possible. Also, this was a fairly tax-smart strategy. This plan made use of employer-sponsored plans. It made use of index funds within taxable brokerage accounts, so this is going to reduce your tax drag over time. And when it came to dividend-paying stocks and dividend-paying funds, it put those in the Roth IRA. So it wasn't really about just growing your money. It was about making sure you kept as much as you possibly could, reducing your tax bill. The Soul Fund. This was brilliant. I think we could all use a soul fund. Most financial plans forget that money should be used in a way that allows you to enjoy your life for maximum enjoyment. So I love that this plan set aside something for enjoyment today, for the fun. And finally, high yield cash reserves. Rather than simply letting cash sit on the sidelines completely idle, this plan specifically mentioned using a high yield savings account or CDs. This is smart, it's liquid, and it's productive. Now here's what I would tweak. First and foremost, there is too much in cash and bonds. Now safety is important, but I think this plan leans way too conservatively, especially for someone with a long investment time horizon and stable income. Here's the breakdown. $200,000 in an emergency fund, $100,000 in short-term bonds, and $90,000 in bond allocation inside the investments themselves. That is $390,000, or 39% of the entire million in fixed income. Or more importantly, if you break it down by the portion that got invested, it's 55% of the invested amounts. Once you have $100,000 in an emergency fund, whether that's in a high-yield savings or CDs, layering another almost $300,000 on top of that feels redundant and not strategic. Here's what I would do. I would take the cash-like holdings with this portfolio and bring it down to about $100,000. As far as the bond allocation within the investment portion itself, rather than sitting at 30%, I'd bring it down closer to 10 to 15%. Or if you have a really long investment time horizon and are comfortable with volatility, maybe bring it all the way down to 0% and take that portion and then put it towards equities and make sure you're covering yourself for long-term growth. This still gives you a really stable portfolio because you still have a solid cash cushion. It's not about maximizing your risk, but it's about making sure that you're capturing long-term growth wherever possible. You don't want to overly insure a life that's already stable. Next, the individual stock exposure is too high. Next, this plan took $100,000 or 25% of the invested assets and put it in individual dividend-paying stocks. I think that this is incredibly aggressive and a little bit too much concentration in risk for this size portfolio. I would cap individual stock exposure at around 10% of investable assets, but I am an indexer, so this is simply my preference. I believe in low-cost index funds or ETFs in the long term, so I would prefer to see a greater portion of the investments go into those type of funds. I think going on single stocks inherently introduces too much risk into a portfolio. Remember, the goal here is to build wealth long term and reduce volatility. If we want to start taking the plan a step further, we could plan for future Roth conversions. Maybe you know down the road there will be a time where your income drops. Maybe you step into an early retirement or you have a career break. This can really be a golden opportunity for a Roth conversion. By converting during a lower income earning year, you move money from a tax-deferred account into a tax-free account and pay taxes at a lower rate. And it's not just about tax savings now. This would give you greater control of your money down the road, because once this money is in a Roth account, you get more control on when and how you take these withdrawals, as you are not subject to RMDs. Also, there's tax benefits for passing on a Roth to your heirs as they inherit this money tax-free. Also, I think it's a really good idea to layer in some risk management. As your net worth grows, protecting it becomes just as important as growing it. This could mean umbrella insurance for liability protection, maybe a carve-out for long-term care in the future, and income protection, maybe through disability insurance if you're still working. These may not be sexy, but they are silent protectors that keep your plan intact for no matter what life throws at you. Next, ensure that you build or update your estate plan. Even high earners often skip this step, but if you care about your loved ones, this is a must. At a minimum, you need a will, a power of attorney, a healthcare proxy, and guardianship plans if you have children. And if you want even more control and privacy, consider a trust. These items really aren't just about protecting your wealth, they're also about protecting the people you love most. Next, I would say create and stress test your plan. Most people don't have a clear financial plan, and without one, you're not just unprepared, you're kind of aimless. So you want to have a structured financial plan that is tailored to your life. But building that plan is just the first step. Over time, and as you approach retirement, you want to make sure to stress test it. What if the market crashes early on in retirement? Are you still covered? What if inflation stays high? What if you retire 5 years earlier than planned? When you can confidently answer all of these questions and more, that's where peace of mind comes in. And finally, start legacy planning now. Legacy planning isn't something you only consider at the end of your life. Truly, it should shape your money decisions throughout the course of your entire life. It might look like opening a 529 for your child, or setting up a donor-advised fund, or gifting appreciated assets, or simply naming beneficiaries on your accounts. It's not simply about writing a will someday. It's about having a plan that truly reflects your values every step along the way. So at the end of the day, what happens if you give a machine $1 million and ask it to create a plan that gives you peace of mind? You get a thoughtful, grounded, and human-centered plan. It protected the downside, prioritized joy, and avoided unnecessary risk. But personally, I thought the plan leaned a little bit too safe and too conservative, and I think there were golden opportunities for improvement for long-term growth. So overall, final grade, I would say a solid B. That's better than most people get, but with a few tweaks, you could certainly turn this plan into an A. But maybe at the end of the day, our takeaway from this isn't about being perfect. It's about building a plan that works for you. So, same question to you. If you were given $1 million, what would you do with it? Care to share your thoughts in the comments down below? I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. I'll give that fire truck a minute. That fire truck is annoying. It's like, I thought they actually turn off the siren at some point. Step 2 is to step 2 is to oh my gosh, that's a lot of S's. This fund is a great reminder that money should I can't do S's today. Goodness gracious.